If you are wondering what the theoretical basis for the economic profit framework is, this video will help you understand why this framework can help us connect with the economic and business realities of our firms. And yes, it will involve some maths. An equity interest in a firm entitles us to a stream of future dividends for the rest of the life of the firm. If, for example, the firm is liquidated or taken over at the end of its life, this would include a final dividend representing the remaining assets after all liabilities of the firm have been settled, or alternatively, a payment to the equity investors from the party taking over the firm. That is what an equity interest entitles you to, nothing more and nothing less. The equity value of a firm is the present value of expected future dividends. We saw in the video Theoretical Basis DCF framework how the discounted cash flow DCF framework is based on the dividend discount model. The economic profit framework is also based on the dividend discount model. We can replace expected future dividends with economic profit. A simplified mathematical proof of this is in the study guide, Chapter 3, Section 3.4. Replacing dividends with economic profit has several advantages. Dividends are not the source of value for equity investors. Rather, they are simply a transfer of value between a firm and its equity investors. For example, a firm may decide to increase its dividend payout ratio, the proportion of earnings distributed to its ordinary shareholders, from 10% to 90% of earnings. Assuming no change to earnings, this would result in dividends increasing by 9 times. Does that now mean the equity in the firm is worth 9 times what it was worth prior to the change in dividend policy? That does not seem to make much sense. It is difficult to forecast a firm's future dividend policy to eternity or to the end of a firm's life because it is based on the discretion of a firm's management and board of directors, who may consider a range of factors in making their decisions. To value the equity of a firm in practice, we will need to move in behind the dividends a firm pays its equity investors. We will need to engage with the economic and business realities of a firm that are driving the future creation of value by the firm for its equity investors. One way to do this is to focus on the economic profit of a firm. There is a relationship between a firm's dividends, its net cash payments to its equity investors, and its economic profit. For this reason, it is possible to focus on economic profit rather than dividends when valuing equity in a firm. A valuation of the equity in a firm based on discounting future economic profit of a firm draws on the same theoretical base as a valuation based on discounting future dividends. Namely, the value of equity is the present value of expected future dividends. By focusing on economic profit rather than dividends, we no longer need to predict the dividend policy of a firm. And by focusing on economic profit rather than free cash flows, we can focus directly on the value-adding activities of a firm. Free cash flows are a measure of transfer of value between a firm's operating and financial activities. As with dividends, they are not a measure of value creation. To value the equity of a firm in practice, we need to engage with the economic and business realities of the firm that are driving the future creation of value by the firm for its equity investors. We can get closer to these by focusing on economic profit, that is, on the generation of earnings over and above the opportunity cost of the capital it is using to generate those returns. The opening book value of equity plus expected comprehensive income less expected dividends equals the expected closing book value of equity. This simply means that the book value of equity in any year can only be increased from the previous year's level by earning comprehensive income or be reduced by the amount of net dividends paid to its equity investors. This can also be expressed as dividends equal opening book value of equity minus closing book value of equity plus comprehensive income. By substituting this for dividends in the discounted dividend model, we can arrive at the economic profit model where the value of equity equals the opening or current book value of equity plus the present value of abnormal earnings. See Chapter 3, Section 3.4 in the study guide for some further information on the maths involved. Abnormal earnings is the difference between comprehensive income and the cost of capital. And as we will see in later weeks when we focus on the enterprise, if we think the financial activities of our firm are not adding value, we can recast the economic profit model as the value of equity equals the opening or current book value of equity plus the present value of abnormal operating income. Where AOI small t equals abnormal operating income in year T, which equals operating income OI minus WACC times book value. And WACC is the weighted average cost of capital, or the cost of capital for a firm's operations. By focusing on abnormal earnings or abnormal operating income, rather than dividends or cash flow, there are some practical advantages. We no longer need to be concerned that the value of a firm will be affected by its dividend policy, nor by the amount of its operating cash flow it reinvests into its operating activities. We can focus our attention and our efforts on analysing a firm's financial statements, on those aspects that are potentially adding value. This should help us more effectively engage with the economic and business realities of a firm. For further information on the theoretical basis for the economic profit framework, go back to Chapter 3, Section 3.4 in the study guide, and review the many ways to assess value weekly questions. Also answer, write and rate questions on many ways to assess value in Peerwise.